Howdy, Jacob here. Today we're looking at Amphenol Corporation in the electronic equipment, instruments, and components industry. $79 billion market cap with an $80 billion enterprise value. So a little bit of net debt here. Looks like with their subsidiaries primarily design, manufacture, and market electrical, electronic, and fiber optic connectors. Really, United States, China, globally. Founded in 1932. So they've been around for quite some time here, and the growth is still pretty sexy. I mean, we're looking at 10 to 12% CAGR over the last 10 years. Very impressive, with gross margin and operating margin both slightly higher, meaning that the company's become more efficient with the money coming in. And dividends going up, earnings per share going up, return on invested capital also going up. A lot of good signs here. Balance sheet shows about $1.6 billion cash-like products, just under $4 billion long-term debt, $350 million short-term debt. At $4 billion long-term debt in relation to their cash flow. Okay. I wonder if this other is really their capital expenditures. That's what I'm going to presume. Sometimes I actually contacted QuickFS about this, but sometimes capital expenditures, the way I can get pulled in from the 10Ks report, it gets a little wonky. But I'm going to presume that that's what it's for. But 5-year average free cash flow, you're looking at probably $1.5 billion. And so that's about 2.5 years of their 5-year average free cash flow, and it's growing. So we're not concerned about that. Capital expenditures are growing, so they are reinvesting back in themselves. They could also just be growing because they're making quite a bit of acquisitions. Their other use of cash, they use all their use of cash pretty much. You can see here they made acquisitions, increased reinvestment, bought back shares, reduced their debt, and paid a dividend. That $500 million dividend is quite big. You're looking at about 33% of their free cash flow. Not concerningly large, but just for a company that seems to be growing, has a great return on invested capital, seems like a good amount to me. But they're buying back shares. They're really just doing the dollar cost average method. They're buying back, $400 to $700 million a year. So you do want them to be buying back really cheap shares. At least dollar cost averaging is fine because they're going to do roughly with what the company's doing. But you want to buy back more shares, especially when the company's selling for a cheap valuation. And obviously that's suggestive to who's doing the valuation. But really, I'd say a hefty majority of their money is going towards acquisitions. So let's start making some assumptions here. Revenue growth side. I think 7% seems pretty reasonable. Growing an 18 PE for them. Margins. Let's do 15, 14. Share change. What's their 101 is from stock-based compensation, buyback, 500 million, so 400 million. That's about 0.5%. Okay, so 0.5% reduction in shares. That's about 30% of their free cash flow. Their dividends currently 30%. Let's increase that just 1% so they can say that they're whatever, a dividend aristocrat or whatever people say. And then the rest of the money is going towards reinvestment to get that 7% as well as acquisitions. And I think I'm pretty comfortable with that. Right now, it does look a bit expensive, but definitely a fantastic company I want to own. But again, I just think it's a bit expensive and frothy at the current price. But definitely a company I'd want to own due to its impressive growth. For being founded in 1932, they still have a lot of growth. They still have grown very heavily. They're becoming more efficient, meaning that their margins are increasing greater than their revenues are increasing, which is awesome, and great production of free cash flow. So, company you want to own, just at the right price. So, thanks for watching. Have a great rest of your day.